You're watching Metals in Motion. I'm Thalia Hayden with ETF Guide. We're glad to see you again. The global energy map is being redrawn in real time. As volatility in the Middle East puts the world's oil and gas arteries under pressure, the conversation has shifted from the pipeline back to the reactor. In a world of geopolitical upheaval, energy security isn't just a goal, it's a survival tactic. This is why nuclear power is reclaiming the global spotlight. Joining us now to discuss this further is John Ciampaglia, CEO at Sprott Asset Management. Welcome, John.
Yeah, thank you for having me back.
Now, for nuclear, the narrative has shifted from alternative energy to mission-critical baseload power. How does nuclear power compare to other energy sources?
Yeah, well, obviously, this conflict in Iran has had an incredible impact on a number of supply chains, whether that's oil, gas, LNG, and other derivative products like sulfuric acid, urea, you name it. And it is having a really incredible impact on countries that are dependent on that region for their feedstocks of fuel and other industrial commodities. And this is really highlighting the fact that uranium, which is the fuel for nuclear energy, has been absolutely uninterrupted, has had no impact at all from this conflict. So it does help to illustrate the benefit of diversifying your energy mix, meaning producing electricity from many different sources, so you're not overly reliant on one type of fuel or one type of supplier. And this is the second kind of energy shock that we've had in just 4 years, which is really, I think, highlighting the benefit of having nuclear energy, which has very high density and operates all the time, which is why it's called baseload power.
We see big capital flooding into nuclear projects. Recent deals include large-scale partnerships to deploy next-gen reactors and restart dormant projects. How is the surge in institutional money changing the game for uranium and the nuclear sector?
Yeah, there is a scramble right now to secure energy. And when I say energy, what I'm really referring to is electricity. And what is driving electricity demand? It's things like AI data centers. These are very electricity intensive operations. And there's an AI race going on right now between the US and China and other countries. Everybody wants to be the leader. And one of the big obstacles that we're learning about is electricity. Yes, you need power chips and you need transmission lines and all of the rest of it. But electricity is proving to be the bottleneck. And this is where nuclear energy has kind of entered the story with artificial intelligence, because many of the companies pursuing these AI visions, like Microsoft and Google and Meta, they've determined that nuclear energy could be one of the sources to help fill this gap. And so they've announced a lot of different financial transactions with large utilities, startup companies that are developing the next generation of smaller reactors. And they're really putting their capital behind these projects. They're often signing very long dated power purchase agreements at prices for electricity that are way above the current market level. So there is clearly a demand going on, and nuclear is becoming, I think, a very important part of the solution in terms of meeting the energy low growth story that we're starting to see in certain parts of the world.
Uranium demand is accelerating faster than supply. Can miners realistically scale production in time to meet that surge?
Yeah, it's a really good question, because if you think about how long it would take to, say, build a new AI data center, you're talking about, 3, 4, 5 years perhaps. If you think about how long it would take to build a nuclear power station, that's obviously much longer. And to bring a new uranium mine from discovery to production could be 15 or more years. So there's a real mismatch in terms of time to build infrastructure related to electricity production and time to bring the necessary fuel to market. And this is why there's a real push on right now to restart old mines, to expand existing ones. And over the last 5 years, we've seen the production of uranium go from 125 million pounds in the year 2021. And last year, it's up to 175 million pounds. So that's really great. That is obviously translating into higher revenues and profits, and the ability for a lot of these companies to restart old projects or bring new projects to market. But even with that big increase in production, the market is still experiencing a supply deficit, meaning we're still using more uranium than we're producing. And that number is only going up from here as more new reactors come online and more new designs are in the works. So that supply deficit is in place, and it's only going to get worse, which is ultimately bullish for the commodity price and the related uranium mining companies.
Uranium miners have delivered strong returns over the past 1, 3, even 5 years, outperforming the S&P 500. As we move through 2026, how is the sector performing today, and what's driving the latest momentum?
Yeah, I think everyone is kind of connecting the dots that I just laid out around how nuclear energy is going to receive a larger share of the overall electricity pie in the coming years as countries look to diversify and add more load growth to their systems. That is for sure. Investors obviously see this opportunity. They see the increase in production, the increase in pricing for the commodity. 5 years ago, the commodity price was around $25 a pound for uranium. Now we're talking about in the high 80s per pound. So there's been a real lift, and obviously valuations of these companies have increased to reflect that. And that's obviously why capital is coming back into the sector. We've seen very good inflows into physical uranium products like our own, as well as the uranium mining ETFs globally. A lot of capital is coming in because investors see that the fundamentals are durable and they are expected to play out for many, many years. This is a theme that we think is still in the early innings, and it is a very long duration cycle. So this is why capital is coming back into the sector. This is why their returns have been robust, because there's been a real, wholesale re-rating of the industry as it's come back into favor.
Wonderful. Thank you, John. And that does it for today's episode of Metals in Motion. For more information on what we discussed today, you can visit SprottETFs.com. And if you enjoyed the show, please hit that like button, leave us a comment below. I'm Thalia Hayden with ETF Guide. Thanks for watching, and we'll see you next time.